Hey there, fellow investors. Iggy here, your friendly neighborhood investing iguana, guiding you through the jungle of the Singapore market. Fresh off another record month of watch hours on our channel and being ranked one of the fastest growing finance blogs in the region, I'm here to cut through the noise. Today, the market is sending us some seriously mixed signals. On one hand, we're seeing flashy growth numbers from tech darlings. On the other, we're getting some boardroom drama that could make a sitcom episode look tame. So how do we make sense of it all? Let's dive in. The market felt a bit hesitant today. The Straits Times Index, STI, saw a slight dip, reflecting a cautious mood among traders. It wasn't a day of big wins or major losses, but rather a day of sorting through company-specific news. We saw pockets of strength in some areas, but governance issues in others kept the mood in check. It's a classic stock picker's market, where the company you own matters more than the overall market direction. Let's kick things off with electric vehicle, EV, maker NIO. They just announced some eye-popping delivery numbers for October 2025, with a massive 92.6% jump in vehicles delivered compared to last year. They've now delivered over 913,000 vehicles to date. You'd think the stock would be soaring, right? Well, just before the news dropped, its shares actually dipped by about 1% to US $7.04. Iggy's take. This is a classic case of great numbers, but what's next? The massive year-on-year growth is impressive and shows NIO is scaling up fast. However, the EV space is incredibly competitive, especially with rivals like Tesla and BYD breathing down their necks. The slight share price dip suggests the market had already priced in high expectations. For investors, the key isn't just delivery numbers anymore. We need to watch their profit margins. Are they selling more cars but losing more money on each one? That's the billion-dollar question. Strong deliveries are great, but the path to profitability is what will truly drive the stock in the long run. Next up, one of Singapore's industrial giants, CapitaLand Ascendas REIT, CLAR. Their latest update showed portfolio occupancy slipped slightly to 91.3% in the third quarter. The manager explained this was mainly due to the addition of a newly redeveloped property at 5 To Guan Road East. Without it, occupancy would have been stable. The unit price edged down a tiny bit to $2,082 before this news came out. Iggy's take, don't panic over this headline number. When a REIT adds a big brand new building to its portfolio, it's normal for the overall occupancy rate to dip temporarily. It takes time to fill up a new property with tenants. The real metric to watch is the underlying portfolio's performance, which they said was stable. This shows their existing properties are still doing their job. As an investor, I'd be keeping an eye on how quickly they can lease out the new To Guan property. If it fills up fast, it's a sign of strong demand. If it stays empty for too long, it might signal a softer industrial rental market. For now, it's a blip, not a crisis. Things are getting interesting over at Yangzijiang Financial. They're spinning off the maritime investment segment into a new company, YZJ Maritime Development, which will debut on the main board on November 18th. To prepare for this, the executive chairman, CEO, and CFO have all resigned from YZJ Financial. This news came after the stock closed down slightly at $1.06. Iggy's take, a spinoff can be a smart move. It allows two different businesses to be valued separately by the market. YZJ Financial wants to be a pure-play investment manager, while the new YZJ Maritime will focus on, maritime assets. This can unlock value for shareholders. However, the mass resignation of top leadership is a red flag you can't ignore. While it's part of the spin-off process, it creates uncertainty. Who is steering the ship at YZJ Financial now? Investors should watch for announcements on the new leadership team. The success of both companies will depend on the strength of the people in charge. Construction and property group Hur is venturing into new territory. They've taken a significant stake in a fund that just bought the former Hotel Miramar Singapore for $160 million. This is their first hotel investment. The market didn't react much, with the share price staying flat at $7.25 as before the announcement. Iggy's take, this looks like a savvy diversification play. Hur is known for its dormitories and residential projects. Moving into hospitality, especially with a well-located asset like the former Hotel Miramar and Havelock Road, could be a great long-term move. The tourism and travel industry is back in full swing, and a refurbished hotel in that area has a lot of potential. It's a different ballgame from construction, so there will be a learning curve. I'll be watching to see how they redevelop the property and what their strategy is to compete in Singapore's crowded hotel market. Now for the boardroom drama I mentioned. First, Nam Lee Pressed Metal announced its managing director, Eric Young, was interviewed by the Corrupt Practices Investigation Bureau, CPIB, following a whistleblower report. He has not been charged and is free to travel. The company's shares, which had been halted, will resume trading on Monday. Separately, Fuyu Corporation has fired its group CEO, David Xiao, for gross default and misconduct. This was effective immediately. Fuyu shares fell 2.8% to still $105 before the weekend announcement. Iggy's take, okay, let's talk about governance. For Nam Lee, even the hint of a CPIB probe is enough to spook investors. While it's crucial to remember Mr. Young has not been charged, uncertainty is a stock's worst enemy. The market hates it. Expect volatility when the stock resumes trading. This is a reminder that strong corporate governance is non-negotiable. As for Fuyu, terminating a CEO for misconduct is a bombshell. It signals deep problems at the leadership level. This isn't just a change in strategy. It's a crisis of integrity. The company needs to be transparent about what happened and who will lead them forward. Until there is clarity, it's very difficult for investors to have confidence in the company's direction. Leadership stability is paramount. So, what's the big picture for us today? It's a tale of two markets. On one side, you have companies like NIO posting fantastic growth numbers, reminding us that innovation and expansion are still happening. On the other side, the drama at Nam Lee and Fuyu highlights the critical importance of good leadership and clean governance. A great business idea can be completely derailed by a crisis of trust. For retail investors like us, the lesson is clear. Know what you own. Don't just look at the shiny growth numbers. Dig a little deeper. Who is running the company? What is their track record? Are there any red flags in the boardroom? In a mixed market like this, strong, stable, and trustworthy leadership is worth its weight in gold. That's a wrap for today. Hope this helps you connect the dots. What are your thoughts on these stocks? Drop a comment below and let's discuss. And if you want to get these insights and more detailed analysis straight to your inbox, don't forget to subscribe to the premium newsletter. Let's get smarter together.